The Federal Reserve will begin raising interest rates in March. It's a departure from pandemic-era policies that have been in place since March 2020, pegging the benchmark rate to zero. Fed Chairman Jerome Powell says the move is designed to temper economic growth. Americans have seen decades-high inflation rates lately, eating into wage gains and household budgets. The Fed chairman added that he thinks there is quite a bit of room to raise rates without threatening the labor market.
Good afternoon. Well, I would say.
Well, to help us make sense of all this, we've got Stephen Beardsley with us from DW Business. Okay. Steve, investors around the world have been eagerly awaiting this decision from the Fed. Why is it so important?
Well, it's important because, let's start with the domestic economy, right? Hiking rates essentially makes borrowing more expensive. And when that happens, that cuts into corporate profits and it also cuts into loans. That means mortgages, car loans, credit cards, things like that. That brings down consumer spending. So overall, it takes steam out of the American economy. The American economy is the world's biggest economy, and it spills well out over its borders. That means that any time that economy contracts a little bit, you're going to see a reaction across the globe. Now, there's two other things to consider. One is that for exporters into the U.S., this could be good for them because the U.S. dollar should get higher in relation to their currency. That's a good thing for them. But for emerging markets, it could be a bad thing. One reason is that many peg their debt to U.S. dollars. If the price of that debt then goes up, they have more to pay back. Another reason is that many have, they've seen that what happens is that when borrowing rates in the U.S. get more attractive, I should say lending rates, you buy a bond, for example, you're getting paid more, a higher interest rate for it, that money then pulls out of emerging markets. And so that's what they're going to fear. If you're in India, if you're South Africa, if you're Brazil, you're going to be watching closely.
Okay, so there are global implications to this, but it's really just correcting something in a situation where there's very high inflation. What does this mean, really? How big of a shift is it?
Well, in many ways, the Fed has been telegraphing this already for weeks. You know, there was some expectation that it could be a sudden interest rate change. That didn't happen. There was an expectation that perhaps it would be a 0.5% change. It's only going to be a 0.25% change, most likely. So, for the most part, markets had already factored a lot of this in. But as you mentioned, this is a shift from 2 years of a much looser monetary policy. And this is the U.S. basically saying the dynamic has changed. We are now moving on to a post-COVID economy, but there are still a lot of questions that are making markets a little jittery. How many rate cuts are there going to be? How bad is inflation going to be? What's going to curb it? So the dynamic has changed, but not everyone is completely sure what that dynamic looks like from now on.
Steve, thank you so much. Steve Beardsley from DW Business.